Hi, I'm Christine Benz from Morningstar. I'm live at the Money Show in San Francisco. Joined today by Sam Stoval. He's Chief U.S. Equity Strategist for CFRA Research. Sam, thank you so much for being here.
Good to be here, Christine.
Sam, your presentation at this conference is about whether it's time to buy or bail on stocks. And it's timely because we had some significant volatility in the U.S. market today. Can you kind of sum up the takeaways from your presentation? Are you telling people that maybe it's time to de-risk, or should they sit tight in stocks?
I think they should sit tight. I mean, we already have a slight underweighting to U.S. equities just because we feel that we're pretty long in the tooth in terms of the stock market cycle, in terms of the economic cycle, etc. But, you know, that's the reason why you're diversified, is because if we do have bumps in the road, then the fixed income portion, the precious metal portion, or whatever, will help offset those bumps. But what I'm telling investors is, yes, there is reason to be concerned out there, that it's just a matter of time before this economic expansion falls into contraction. We are looking at probably one of the biggest concerns, which is an inverted yield curve.
Exactly. That's what spooked the market this week.
Oh, absolutely. And rightfully so, because every recession has been preceded by an inverted yield curve, but not every inverted yield curve led to recession. It has led all the time to a Fed rate cutting cycle, which we found to be the case on July 31st. So yeah, we end up now in a rate cutting cycle. Whether it turns into recession, yeah, it will. I just don't know when.
Okay, so if investors are looking at their portfolios today, they should have kind of an asset allocation blueprint in mind, but they're looking at doing some repositioning. We've seen very strong performance in the high growth sectors. Maybe they want to put some money to work in sectors that haven't performed as well. What would sort of be on the list of things that you might expect to perform well in the environment that you see unfolding?
Well, first off, I think the investors should do their research, and what they'll find is that value doesn't end up being the panacea that a lot of people think it is. If you look to the S&P 500 growth and value indices, growth has beaten the market and value on average 6 months before corrections and bear markets, during corrections and bear markets, and 6 months after. So interestingly enough, maybe it's simply the composition of those indices, but in terms of growth versus value, growth tends to do better. So if you were saying, yeah, I want to own growth, but I don't want to buy at these levels, then this is the kind of time period where you maybe say, I'm going to wait for better prices ahead. So what I would be doing is asking yourself, at what price? Because we could end up just this being a pullback, which, like we experienced in May, was down only about 7.5%. Maybe it ends up being a correction, a deep one, like we did in the latter part of 2018. Or as Fred Sanford used to say, Elizabeth, it's the big one. You know, maybe this is the big bear market. And again, you want to find out which stocks, which indices, ETFs that you want to own when they are at bargain basement prices.
Okay, so if people are looking at a shopping list of sectors, it sounds like you think that playing a little bit of defense with your equity portfolio is the way to approach it.
Yes, I just did a master class and was talking about seasonality, and we know the old saying of sell in May and go away. I don't really believe in that. I think you are better off rotating than you are retreating. What I mean by that is gravitate toward the more defensive sectors in the traditionally challenging May through October period, but then emphasize the cyclical sectors November through April, when the market tends to do significantly better. So you can do that by rotating into individual ETFs, or you can own an ETF that does this for you. One reason why I'm talking about it is it has my name on it. It's the CFRA-Stovall Seasonal Rotation ETF. The ticker is SZNE, but investors should check it out on paceretfs.com to see if it's something that is right for them. But basically, you could use seasonality, you could use momentum that basically says on a trailing 12-month perspective, you want to own the winners, not the losers. You want to own those top 3 sectors that have been the outperformers, or the top 10 sub-industries that have had the best performances, because about 70% of all calendar years since 1995, this strategy has outperformed the market.
Okay, Sam, always great to get your perspective. Thank you so much for being here.
My pleasure.
Thanks for watching. I'm Christine Benz here at the Money Show.